All right. My name is Chris Campbell. I'm a practicing CPA and I work with individuals and small to mid-sized businesses to help them pay the least amount of taxes possible while keeping them out of jail. So today we're going to talk a little bit about interest and penalties. So the reason why I bring that up is that a lot of times, of course, is exactly about that interest and penalty. I'll have clients, they pay their taxes, and let's say that we paid a bit after the deadline. And even if it's the April 15th deadline, a lot of people go on extensions. And even though we may file within the extension period and we'll pay the taxes that are owed, sometimes they get shocked or surprised by they get something in the mail and they're like, oh, yeah, I paid my taxes in full. It says here that I owe additional. What is this about? And most of the time it's interest and penalties. So there tends to be confusion about interest and penalties because, again, they filed within the extension period of time and they paid in full by the extension period of time. Sometimes it's confused about having to owe additional. So it is legit, but I figured I'd take the opportunity to go through different or common penalties and then also discuss interest as far as how that works when making your payment. A lot of business owners pay late and they usually wind up owing. This is a common thing for some of my business owners, especially if you're an owner of a closely held business. So the first penalty, which is a common penalty, is the failure to file penalty. And basically you get that penalty if you file late. All right. So with most folks, and I'm talking about more on the individual side, the business side is a little different, but on the individual side, if you file after the 15th deadline, you get hit with this penalty, but you can get extensions, right? You file an extension by April 15th, you get 6 months. That brings you to October 15th. So if you file an extension, you have until October 15th to go ahead and file to avoid this penalty. How it's calculated, it's 5% a month for every month until you pay it off. Okay? And it maxes out at 25% of the tax. So I'll just give an example. If you file and you owe $10,000, 5% a month until that penalty hits $2,500 because now you capped out at 25%. So every month they hit you with an additional 5%. So that can be pretty punitive. I always tell folks to, at bare minimum, file the return. Even if you don't necessarily have the money to pay right away, it's always good to just go ahead and file the return by the due date because, again, it's pretty punitive if you don't at least file in time. All right. And mind you, and I do want to mention that these penalties really only take place if you actually owe taxes. So if you don't owe, then you don't have to worry about any of these penalties. So even if you don't owe, let's say that you file your tax return 6 months after the due date, but you would do a refund. That instance, pretty much most of this conversation doesn't even apply because pretty much IRS and most states don't care file late if you don't owe them. They only care if you owe them. They owe you, you can file whatever you want. They don't care. They probably prefer if you don't file because they don't have to pay you back. But all this pertains to if you wind up having a balance once you file your return. So it's one of those things where if you're not sure what your balance is going to look like, I know that happens a lot with folks that are business owners and self-employed folks. You don't know, but most of the time as a self-employed and an individual, you wind up owing. Just make sure that you file the return in time. And like I said, it's 5% a month until you file. So key thing there is that. The next common penalty is the failure to pay. And that's pretty much as it sounds, right? So if you don't pay the April 15th deadline, you do get penalized for not paying by April 15th. Now, even if you do file an extension, so that's another thing where this really gets people is that you file an extension and you file within the extension period of time, and then you may even pay the balance within that period of time. That penalty clock starts after April 15th, whether you file an extension or not, doesn't matter. So understand that. So along with interest, which I'll explain it in a minute, but then that clock for failure to pay starts April 15th, regardless of extension. So keep that in mind. So a little less lenient at the 5% of the balance every month. So big difference between 5%, 0.5%, right? Pretty big swing there. Penalty is 10 times more for not filing on time versus just failure to pay. So 0.5%, memory serves me correct. So the day you wind up filing the tax, know that you can't pay it all at once, you can get into a payment plan. And this is also good to know, is that interest and penalties still apply while you're in payment plan. So if you wind up owing and hop into one, don't think that that balance at the time that you enter into the plan is all that you'll pay. You'll pay more because interest and penalty will accrue on the outstanding balance until it's completely paid off. Now, I do believe that if you are in a payment plan, that penalty does get reduced sometimes from 0.5 to 0.25%. So they are a little more lenient on that. I don't know if they do it all instances, and I'm not sure the rhyme or reason as far as if they do it for some and not for others, but there is the possibility that penalty could drop almost in half from 0.5 to 0.25 if you're in a payment plan. But be prepared to pay about, like I said, 0.5%. And usually what they'll do is, if you are subject to both these penalties, the failure to pay and the failure to file, they usually mash both of those together and will still cap you out at 0.5% of the overall tax bill. So something to know there. So let's say that both maxed out at 25% of the bill, both penalties, and let's say it's something where you didn't file and you didn't pay for eons and you max out. So normally what they'll do is they'll just max out at the 25% once. So it's not as if you're going to get 25% penalty for this fail and file penalty and then another 25% for failure to pay. And it's now 50%. So usually if you have both, they'll mash the two together, and the most you'll pay is 25% of the bill. So those are the two common ones. There's one more common one. So is failure to pay estimated taxes. So that is another common one. This is an interesting one here. So even if you pay the bill on time, right? And let's say you file by April 15th and you pay by April 15th, there is another penalty that could possibly apply to you, and that's failure to pay estimated taxes. So some folks take the strategy of, okay, well, I'll just pay my taxes. I'll save and I'll put it aside, and I'll just pay all my taxes at the end of the year. And some people take that approach, and that's okay. But understand that there is a penalty for not paying. The IRS in many of the states, they want you to pay your taxes over the course of the year. They don't want to wait for their money. I guess that's really what it boils down to, right? So just like you more likely don't want to wait for your money, they don't want to wait for their money. So if you do, and you stack the money and you go ahead and pay it at the end of the year, they do ding you for that. Not super punitive, but nonetheless, they do ding you for not paying that. And it's called a failure to pay estimated taxes penalty. And so that penalty is usually tied to the interest rate that they charge. So as of recording of this video, I think it's currently at 8% right now. It's either 7 or 8%, and they do it by quarter. So the idea is that you're supposed to make your quarterly payments each quarter. They'll assume that they'll take your balance that you owe, break it up into 4 pieces, and then charge you interest accordingly for each quarter. You're supposed to make that payment. Now, a couple ways around this is that, let's say, especially as a business owner, you could be in a business and your income can fluctuate, right? That's the nature of business. So there are some businesses that are inherently busier at some times in the year than slow ones at some times of the year. Even myself, right? Tax time is way busy for me. Pension time is busy for me. Some are slow. So the income is going to fluctuate. With that said, there is a provision for that where you can indicate on your return the levels of income that you made. So instead of the IRS or the state assuming that you made the same amount of income throughout the year, so that you don't get tied up with not paying the estimated taxes or not paying enough, you can annualize the income, so to speak, where you can break down the level of income that you made throughout the year over the quarters, so that if you're making your payments in conjunction with the money that you're making, you can avoid it. So busier months, you may pay more. And once that you're not busy, you pay a lot less. If anything, the penalties can get reduced based upon the amount that you pay, or at least you let them know the amount of income that you made over the course of the year and how that fluctuates. And then you properly reflect that in your return. Then there's a way to avoid the penalties with that. The other way to avoid not paying enough through the course of the year is if you pay enough based upon your last year's taxes. So you can avoid the penalty. There's a rule where if you pay either 100% of your last year's taxes or 90% of the current year's taxes prior to January 15th of that year, then you avoid the penalty altogether. Prime example can be, let's say you usually pay your estimated taxes, and let's say that in 1 year, your income explodes, right? And your income is going to do well over what you did the previous year. So instead of trying to have to figure out to pay the estimated taxes each quarter, one way you can avoid the penalty is just look at what you paid the previous year. And as long as you pay that much, then you avoid it. Now, if your income is over 150,000, then you have to pay, I think it's 110% of what the tax bill was last year. So if you go 150,000, as long as you pay 110% of what you paid last year in taxes by January, then you're fine, regardless of what the new tax bill would be. Sometimes you may get a big jump or a big pop in income, like a one-time thing. So they don't penalize you for that. So that's the rule to follow to make sure that you avoid it. But ultimately, IRS, the states, they want you paying every quarter. So do your best to stay on top of that. All right. And one of the other penalties, and it's not as common, but common enough where I've seen it, is accuracy related penalties. So basically, if you file a return and the IRS comes back to you and says, hey, you looked at this return and you missed some items that cause you to owe more income, if the return that you filed is not accurate enough for them, they penalize you for it. So what's considered accurate enough for them is if they come back to you and say, hey, what we have, you should be paying at least 10% more than what you reported, then that's deemed an accuracy issue. And that penalty is up to 20% of the underpaid tax. So if they come back and say, yeah, you owed us actually another $5,000 than what you reported, they'll charge you another 20% on that $5,000. So that can wind up being pretty punitive. And normally if I've seen that or how that can occur is one, let's say you left out a W-2. So I've seen that where might have forgot about a W-2 if you got a number of different jobs, left it out, didn't report it. So I can see that. I also see it a lot, let's say folks that get 1099s. So you get 1099s and you're a contractor or sole proprietor, or even if you're a single member LLC, if you get 1099s sent in your name or your business name, you need to make sure that all of your 1099s add up to what you report on your revenue top line. So if you report everything on a Schedule C or a single member LLC, and you received all these 1099s, let's say that you got 150,000 and 1099s that were sent to you, and yet you only reported, say, 100,000 as your top line, as your sales on that business, they're going to tack on the extra 50,000 to your income. So that in that instance, they're going to tack on that extra 50,000 and you'll probably get hit with the accuracy related penalties. So that's usually based upon what the IRS has in their records. So you want to take a look at the wage and income transcript. So which has a record of all the 1099s that you receive, the W-2s that you receive. So when you get that, they're usually checking against the backdrop of that. So they want to make sure that any 1099s that you receive, they want to make sure that at least from a revenue side, all of those are reported on your income tax return. So make sure you stay on top of that. All right. So those are pretty much the common penalties. But then you also have to understand interest. You get interest on both the balance and the penalties as long as they're not paid. So interest fluctuates based upon what the current rates are in the market, and the IRS sets them every quarter. Based upon what the market is every quarter, they'll go ahead and set that rate. I think, as I mentioned earlier, the current rate is 8%. Don't give me the line about what the actual, like how they calculate it for the Fed fund rate plus a certain amount. But right now it's hovering around 8%. So do understand that interest accrues on both the actual balance that you owe and these penalties. So we can add up pretty quick. Now, there is a way to get rid of penalties. Everybody has a free one-time get out of jail card. You can get first time penalty abate or waiver where they'll give you a one-time pass if you have that. So you get your one-time pass, they'll waive your penalties, but yeah, it's only one time. So don't expect to get that pass again. And even for them to even get that accepted, you're expected to have all your filings up to date at the time that you request the waiver. So have all of your filings up to date, not a whole bunch of other outstanding balances. So you have to request it. So it is up to their discretion. It's not a law that they have to give it to you. It is up to the IRS discretion, but usually that does sway in their decision. So are you up to date with your filings? Are you up to date with the payment date from prior years? So if you have a bunch of other outstanding balances and not in a payment plan, they may tell you no. So the penalties, you can get a one-time pass on that. If you are able to come up with some other reasonable situation that you got hit with the penalties, you can find a way to waiver it. Maybe if you had like a health issue and you could file or something like that, they might give you grace there. But again, it's completely up to them, up to their discretion with that. Now that's just the penalty you can get waived. By law, interest cannot be waived. Nothing they can really do on that end with the interest. The interest you're going to have to eat, but you can use a one-time waiver on the penalties. And then again, if there's any other reasonable thing, but truth be told, in my experiences, I haven't seen too many opportunities where penalties have been waived outside of the first time penalty. So be prepared to pay if you don't get that pass for one time. And like I said, not much you can do about interest. So that's about it. That covers the common penalties and then the interest that you'll more than likely see on a tax notice. So that's all for now. Hopefully this was helpful. And if you have any more questions about this topic or any other tax or account related questions, feel free to reach out. I'm happy to help. All right. That's all for now. I'll talk to you next one.